the most important thing about having about an investment philosophy is having one. We're not going to guess if it's a market too high right now or not. We're going to have a diversified portfolio for some of those reasons that we just talked about, and then we're going to stick to that and not try to decide, is our interest rates going up? What's going to happen with inflation? Bridget, we've been getting a lot of questions from clients in our meetings about the stock market and how things are going and how their performance is going and how are their how are their investments doing, right? And I thought it'd be a really interesting topic for our conversation here today is just to maybe I'd share what how we're looking at things, what sort of resources we share. I'm interested to know how you have this conversation with clients and curious if maybe it's been coming up in your client meetings as well.
Yeah, well, we got two things going on. One is we'll talk about it a little bit, like about the stock market being up, but then we have some people thinking, oh, is it a good time to sell?
Yeah.
So
Yeah.
let's talk this through. So first, let's
Yeah.
talk about the stock performance. Like what's been going on in the stock market? I watched the news and it tells me everything in the world is terrible. But if we get past that, they might have a little note about the stock market being up. So what are your thoughts?
Right, right. Well, it's been interesting for us that we've had a number of clients that say we get to that point in our meeting, we go, let's just take a look how are the investments doing. Like, oh, geez, we haven't looked all that bad news, right? Like, how
Right,
bad's it going on things? And so one of the things that we espouse here, just in general, is well, let's look at the facts.
right,
Right. And let's start from a place where let's take a look and then feelings play a big part in how we all act and do things, but we need to know like, all right, where's the basis? And so, what we I use a resource from a company called First Trust. We can pull up. We'll put a link in the show notes here too. But to pull up this data is what it's current as of this week here, I guess. So year to date through this
720.
and
Right,
and I'll just point out a couple of places. There's 9 million numbers on this thing, right? Not every one of them is super important, but kind of the second line down here, look at S&P 500, that year-to-date column. So far this year, the market, right? When you hear that on the news, that
right,
they're talking generally speaking S&P 500, and that's been up 15% on the year. Right. And for some people, just seeing that, right? Because we've got tariffs, we've got the Ukraine, fill in the blank, all these things going on, and it feels so disjointed, just sort of life, and it probably is. But then you go like, hey, the S&P, the market, as we think about it, that's doing pretty decent, and that's not even a full year, right? That's what are we,
right.
2/3 of the way through the year, whatever it is. So that's one of the things is, oh, wait a minute, sort of stocks as we generically think about them are doing pretty well. We had one client where we looked at their specific performance and it wasn't quite what they were expecting. I said, geez, great, John. We see that, the S&P's up 15% and we're a fair amount lower than that. Well, why is that? And the other thing, and I know that your portfolios are at least kind of similar to ours, is that we don't just buy US large cap
Right.
stocks, right? We've got some small company stocks, we've got some international, right? This whole diversification thing. So take a look here, and then there's also a thing which you don't need to get into the details, but inside of the S&P 500, there's a growth component and there's a value component, kind of two ends of the scale. So we use value things because over time we expect them to outperform. But take a look at small company stocks here, that S&P small cap value. What's that number year to date? 2%. And you can kind of look up a little bit whether it's small cap growth or mid cap. Those non-big companies are down in what is that, like the 5% or even lower range on the year, right? So when somebody says, well, how are stocks doing? Well, one answer could be, hey, they're up 15% on the year. Another answer could be, geez, they're at like 5% on the year. Still not a bad return, but two very different things, right? So because we invest in some smaller companies, and because we invest in some value companies, right? It's not exactly like that. That was the answer for that client. Like, oh, right, what are stocks doing? And I'll just point out the other thing here is that that's all U.S. stuff,
Right.
right? International stocks, and it's this one, it says MSCI World ex-US, meaning the world not including US.
What the
Look
heck
at
is
that number year to date.
that?
Like literally double what the S&P is doing. So when we hear, hey, how are stocks doing? I think S&P. Wait a minute, small companies, they're terrible. international companies, and I'll say that to clients like, how are stocks doing? I'm like, oh, you mean international? They're like, no, 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 that's not what we mean. Look at that stuff, right? And so there isn't one answer. And starting with looking like, oh, those numbers actually kind of across the board look pretty decent. Some smaller, some higher. Like that's the reality of where it is. And just knowing that basis for a lot of folks go, oh, I thought it was going to be terrible. That makes me feel better about things.
Right, right, absolutely. And a lot of people know the stock market's been doing well and they just see their overall net worth going up. In the bond market, not shabby either. I mean, when
Yeah,
I'm thinking about bonds, I want to know what's the interest. And I really like US Treasuries just because they're safe and they'll pay their interest. But sometimes they make more money than that. And that's kind of the situation this year. And that's cool too. I mean, that's not off. That's a lot of times the stock market and the bond market both doing well. That's not a sentence I say that often, because
right,
often they're not
right.
at the same time. The one's going up, the other one's going down. But that's why we have the well-diversified portfolio. So,
Right.
it's cognitive dissonance for us financial planners right now because there's a lot of people that are worried about a lot of things, but and they're worried about the finances, but it's not the stock market is doing well. So one of the things that I've gotten is the stock market's doing so well, I want to sell. Is now a good time to sell?
It
And
absolutely is. Unless it goes up further, then you shouldn't sell, right? One of those. If it's going to go down, you should sell first.
right, yeah,
Right.
I have a story about this. In 2002, I realized that the real estate market was overheated. I had a tax practice at the time, and so I decided not to work with any more real estate clients, like people that were flipping houses and stuff. Yeah, because I was like, this is a house of cards. I saw it in 2002, but it took until 2008 for all of that to actually that bubble to burst. And so if I wasn't investing, it was like if I was investing and I had gotten out in 2002, I would have lost a lot of run up. And
Right.
I haven't looked at the numbers, but I probably would have been worse off than if I just held on and dealt with the up and down. So if you're thinking about selling, I think it says something different to you, different about your approach to the stock market at this point in your life. Because that to me is a red flag for you're not a long-term investor right now, because a long-term investor realizes they have their emotions are okay with the stock market going up and down and the amount that the stock market is going up and down, and is much better to realize that you're not comfortable with it when the stock market's up than realize it when the stock market is down.
Yeah.
That's
Yeah.
not that great of a time to sell. So what are your thoughts?
Yeah, a lot of great pieces in there. One of the things that you made me think of is a client long ago. I can't remember if it was 10 years ago or so, but I do remember that the Dow Jones was at something like 20,000, maybe it was at 22, and they said, golly, I think they had sold a business or something to that effect, and it was like, all right, we had some money to invest, and maybe it was an inheritance, and they're like, geez, with the market so high, and again, this is a decade or more ago, I just can't see investing in the market today. And I remember the conversation because I said, geez, I think you're right. I mean, boy, it feels really high, but here's the philosophy. Explain why we do this. And I just, looking at that first trust thing, Dow Jones is now at 46,000, right?
Right.
You go like, oh, it was really high at 22. Well, what's going to happen when it goes? And that for me is really, it kind of circles back, I guess, on it's the most important thing about having about an investment philosophy is having one and
Right.
sticking to it,
Right.
right? We're not going to guess if it's a market too high right now or not. We're going to have a diversified portfolio for some of those reasons that we just talked about. And then we're going to stick to that and not try to decide, is our interest rates going up? What's going to happen with inflation? Is the market too high? It's
What about
sticking
the
to that
tariffs?
plan.
Oh my
Right,
gosh, what about the tariffs? What
right.
about inflation? Yeah.
Right. And so it's that rebalancing, and we've talked about that on our show before, is you say, listen, when Like this year we just looked at, international stocks have gone way up. What does rebalancing mean? Oh, let's sell some of those and buy the things that haven't gone up so much. A
Right.
year ago, it's interesting, this diversification thing. A year ago, and we can show it on the First Trust document, a year ago, S&P 500 was up 25%.
Yeah.
International stocks 5. Right? Last year, you should have been mad at us and going, why didn't we just put all our money in the S&P 500? Why did we do all this stuff? We could have got 5 times the return. Oh, that's right. This year we're getting double the return going the other way, right? We just don't know that. And that, hey, having a system, rebalancing, selling the things when they go up and buying things when they go down, and not making a prediction based on what we think is going to happen in the future, like that's the key to success. So that's my answer for, is it a good time to sell? It's like, listen, and I think you just said this, if my risk profile has changed, not because the market's high, but
Right.
because, oh, I'm retired now. I feel differently that for the next 20 years, I don't want to take as much risk. Hey, let's make that change today and not wait for the market to go down.
Yeah.
Right. And it's not because the market's high, right? Yeah.
And I would add to that that the people, sometimes I get people who, but I don't want to stop spending, or I'm spending too much, but I don't want to take any risk. So that is that's a tough situation for us, because if you, the people who are de-risking and not worrying about it are the people who are not, could be spending more if they wanted to.
Right.
No.
Right.
And so they're fine. They don't need to try to meet any financial goals. One of the, with being in the stock market, one of the tenets of modern portfolio theory is that investors are risk averse. And the way I describe this to people is, you're not doing it for fun. You're doing it because you need to. Okay. And so if you're somebody who doesn't actually need to, and you would live just fine, if with having all your money in bonds, or maybe just 20% in stocks, because that actually is less risky than having zero at
Right.
research I see. And you're seeing that this is making you feel nervous. The stock market's too high. Why is it too high? So high. Maybe I should get out. Okay, those are all factors that your risk profile, you're changing. And sometimes as people get older, it's normal for their risk tolerance to change. And it's, again, it's great if you see it ahead of time. It's great if you see it when the market's high, not when the market's tanked, because
Yep.
then you've just, lost, you are not in a great opportunity zone then.
Yep. Hey, I think that's a great place to wrap things up here. Again, I'm John Shear and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan Mermel. I've got a fee-only financial planning practice in Chicago, Illinois. John and I are both taking clients. And if you want to reach out to us, you can find our information in YouTube. We also belong to the Alliance of Comprehensive Planners, or acplanners.org. If you're looking for, if you prefer to have an advisor in your area, you can check that out and find somebody there.
Don't forget, hit that subscribe button.